Yeah, it's been a while that we've discussed problems, that we discussed some existential issues that a hedge fund can face. And I think this is an episode where we're going to have to revisit that. There is lots of turmoil in the market. I spoke about it yesterday. We're talking about the short squeezes and the things which are going on with retail investors and Robinhood and things like that. I'm going to discuss all of these. The topic of this episode, however, is how are we, Orange Capital Partners, thinking about this, managing our risk. I said in many occasions that our main purpose of generating wealth by investing in fundamentally new concepts and engineering practices with large impact, our main purpose is, of course, to find those investments, but then also to manage the risk accordingly. This is the Not Even Wrong podcast. It's January 29, 2021. This is Krim Delco. For the day, the fund is down 6.5%. The market's down 2.5%. For the year, we're up roughly 13%. The market's down 1.7%. We're outperforming by close to 15%. The market's still open, so these things could change. But as we stand now, this is the situation. So let's set the stage, and then we go from there. So here's what's going on. We have a bunch of brokers, Robinhood and others, that are enabling a mass of people to buy certain shares. I would say on leverage. This is a conjecture on my side. I think these so-called retail investors that are ganging up on sites like Wall Street Bets and Twitter and whatnot, there's a gang, there's a revolution, there's a mob going after certain stocks, and those stocks are the shorted stocks, stocks that are heavily shorted, and they're buying those stocks. They're paying enormous prices for those stocks. I think the mechanics of this is that you keep buying shares, driving up the price, even though maybe the stock of shareholders, the bulk of shareholders doesn't even either buy or sell. But the transaction that actually determines the market value of the company is the last transaction. And there is a certain mechanism that somehow has proliferated throughout the last couple of months, maybe even years. And that is that you can really drive up the share price of a stock without really fundamental um, with pretty much no fundamental reason, like in the case of GameStop. Now, as it pertains to us and Orange Capital Partners, there is a risk that this same mechanism has happened to Tesla. This is the big risk because Tesla is our largest position. We have about 80% of our capital in Tesla. So if that is true, then of course we're holding hot air here. It's very dangerous to hold a stock that has been driven up by these types of mechanics. If that is the case, then we have to think about a possible correction, a correction in the realm. I was guessing maybe something like 50% is reasonable. I don't think that the fundamental value of Tesla is much lower than 50% of where it is now, but you could make an argument that at $400 a share or 400 billion market cap, the Tesla stock actually is a fundamental buy, and at 800 billion, maybe it's not. So there's sort of this range that we're working with. And the way we're thinking about this, we have 15% leverage as of the beginning of the year. So if we started with $10 million, we had $11.5 million in assets. This is just a number example. These are not real numbers, but just to give an example. So we had our asset value was 11.5 million. Our actual equity against that was, or our NAV was 10 million. So we had 1.5 million in leverage. Now, if that 1.5 million goes down 50% or 60% from where it is now, we're still up like roughly 13%. So let's just keep the numbers very simple. If the 11.5 million halves, we're looking at 6.5 million with still 1.5 million of leverage. That would put us in roughly sort of 22% leverage. So if we go even further down, we could get to about 25% leverage. That is sort of the working assumption that we have. And here's what really matters here. In the grand scheme of things, long term, we're very happy holding Tesla. We think Tesla can be a multi-trillion-dollar company. There's no problem with that. In the short term, we have to make sure we survive. Survival is very important. It's important in biology. It's important in the hedge fund business. There's no point of doing a 10-year DCF on Tesla if you die today, if you go bankrupt, you don't have capital to invest. It would be very painful to not have capital. So you have to make sure you have enough capital to manage a situation like that. Now, again, our assumption is that we are looking at a stock correction of maybe 50% from here. which would put us at about 25% leverage. And here's the key. We hope that at that point, we don't get margin calls from our prime broker. It's possible we get them. Then, of course, that would be very painful, but we don't think that that is the case. So that's the working assumption. So here's the thing. You have to think, what is your worst case scenario? You have to try to understand the mechanics and then manage the risk accordingly to make sure you don't get killed. You have to survive. The goal here is survival. The goal is not to manage our quarterly return or something like that. We can't do that. It makes no sense. But what really makes sense is survive, because we know in the long term, our investments will generate the kind of money that we think we should be generating at Orange Capital Partners. But in the short term, there's a possibility of a correction. The mechanics, again, are, if I just take Robinhood as an example, but it could be other brokers, it could be even brokers like Charles Schwab. It doesn't have to be Robinhood. But the problem with Robinhood is that they are a commission-free broker. They sell data to other market makers. There's lots of convolution in the market. There's lots of front running in the market. There's a lot of things that shouldn't be happening that are happening for Robinhood. In our case, from our point of view, Robinhood should be closed down. It's not an ethical company. It's in a sense similar to Facebook, but much more dangerous because it can create havoc like it's doing right now. So here's the bottom line. We have these mechanics that are happening in the market, and we have to live with them. It has happened before that certain obscure brokers go bankrupt and create havoc in the market. We had that in 1998 when Refco went bankrupt because a deal broke, an M&A deal broke, and then it created a Russian crisis and so on and so forth. We always have these types of situations. In hindsight, we know this was the case, and this is what happened, etc. It is our job as hedge fund managers to anticipate what could happen and to understand the dynamics of the market. We are not traders. In this podcast, we've rarely spoken about things like day trading, margin calls, and whatnot. But it is part of our business. We use leverage. We use leverage because interest rates are very low, and leverage is dangerous because it can create massive corrections that put you in a position where you have to sell. This is in a nutshell why leverage matters. Otherwise, who cares? I mean, the cost of interest that we're paying, for example, are negligible at this. I mean, they're not small. We still pay something like 3-4% of interest on our leverage, but it's much more benign than it used to be. The problem is, again, survival. How can you generate the optimal return on your fund while always making sure you survive? This is the fundamental. This is it. This is what it's all about, really. If I had to summarize the job of a hedge fund manager in one sentence, it is make the most return under the pretext of surviving. That's it. That's it. And then there are other people, actually, they create LLCs and things like that where they just keep blowing up and start new companies. This is not our strategy. We want Orange Capital to be a long-term player the same way we want our companies to be long-term players. So again, if you're an investor or a hedge fund manager that is thinking about doing things, you could do it differently. There's no law against blowing up and restarting a new company. It's just not something we want to do. I guess to summarize, we have a situation in the market. I discussed it yesterday. I think there are fundamental problems here in the market, the short selling. By the way, actually, yeah, here's something that I forgot to say, which is very important. What are the mechanics of short selling? Now, the mechanics of short selling are actually twofold. Number one, you can sell a stock short that you don't own. This is part of the fabric of the market. And much more dangerous is the fact that brokers can actually call your short. So they can force you to buy back the short at any time. This is one of the problems that need to be addressed here. The short sellers themselves, assuming they have good intentions, are at the mercy of prime brokers to, at any point, whenever they deem it necessary, to be forced to cover their shorts. And I think this is probably what's happening right now with companies like GameStop, etc. So this needs to be reformed. We're calling for a reform on that front. We're calling for more transparency. It should be up to the investor to cover their short and not up to the prime broker to force a short, or even let's say the person that lent the shares to the short seller shouldn't have the power to force that same short seller to cover the short at any price. This is not okay. I'm not familiar with the details, but this is something the SEC should be looking at, because the way short selling works right now, the mechanics are too dangerous for short sellers. We at Orange Capital Partners are believers in short selling because it gives you checks and balances. Of course, there are problems with it, but overall, a market is much healthier with shorts than without shorts. Just today, we saw the news that there is a SPAC being prepared to bring WeWork public. WeWork is probably the biggest, well, the biggest short of them all. And of course, a company like that with no real business model and God knows what else they're planning to do can go public in a market where there's no shorts. I mean, it's not crazy to think like that, and that, of course, is a problem. It shouldn't be happening. We need those checks and balances, but we need to reform the mechanics of short selling in the market, and this is something we call for here at Orange Capital Partners. So to summarize, we think that the risk right now is high. We think volatility is warranted given what's going on in the market. These so-called retail investors are driving prices to unsustainable levels. There is a potential that this same happen, albeit slower, with Tesla, and that we could see a correction from that. We think the correction should not be more than 50%. We're prepared for that. We are hopefully able to withstand the 50% correction without margin calls, because our fundamental premise, other than pursuing our mission to generate wealth by investing in fundamentally new concepts and engineering practices with large impact, is to survive. And we have to be able to meet both of those objectives. Thank you.